Hey everybody, today we're going to be doing a bit deeper dividend analysis, a little bit more than your simple screener. We're really going to dig into a dividend's history, into its cash flow, see if that dividend is stable, and if we can rely on it in the future. For today, we're going to take a peek at ABBV, that's ABBVie. If you read any article on dividend stocks for 2021, you're going to be hard-pressed to find one that doesn't mention ABBVie. First things first, let's take a peek at our yield at just under 5%. That's pretty high for the pharmaceutical industry. If we take a peek at some of their competitors, such as Amgen at 3%, Pfizer at 4.5%, and Merck at 3.5%, we see that ABBVie really is on the high end for the pharmaceutical industry. Next, let's take a look at our history, and as we can see, this year they are paying $1.30 per share, and going back to 2013, we can see that their dividend has increased every year among those years. And actually, going back, ABBVie has increased their dividend every year for the previous 49 years. Now, before anyone calls out that ABBVie's only been in existence for about a decade, we have to remember that they were spun off from Abbott Laboratories a few years ago. When a company is spun off like that, they inherit the dividend history, and Abbott has been increasing their dividend for the past 49 years. Therefore, ABBVie gets that same 49-year increase. So that covers our reliability and our increases very well. 2 check marks there. Let's take a peek at our cash flow. As we can see here down in the cash flow line, ABBVie over the last 5 years has increased their increased their cash flow very nicely. We have more than doubled over the past 5 years, and over the last 12 months, we have increased it by 31.5%. Very good there. So now let's take a peek at our payout ratio of free cash flow, and at $8.33 billion in dividends paid divided by our $16.79 billion, that gives us just under our 50% ideal payout ratio. So very good there. Now, how is ABBVie generating their free cash flow? What's making us this money? Can we expect it in the future? In this industry, pharmaceuticals, everything's going to come from the drugs they make. ABBVie is going to develop, market, and sell these pharmaceuticals, these drugs. Now, this is different from some other industries. For example, if you're in the telecom or the tech industry, you're going to have different streams of income. You might have subscriptions and hardware, but for something in the pharmaceutical industry, you're really just looking at those drugs. So let's take a peek at ABBVie's pipeline. And as we can see here, they have 1, 2, 3, 4, 5, 6, 7, 8 drugs that have been approved and they are selling. So they have something of a diversified drug portfolio, if you will. The one issue with ABBVie is that Humira, their best-selling drug, comes off of patent in 2023, and Humira accounts for about half of ABBVie's revenue. Now, if you go into some articles on ABBVie, delving into them a little bit more, you're going to hear a lot of doom and gloom that this is really going to cut into their revenue, cut into their cash flow, but you have to remember that just because a drug is going generic doesn't mean that no one is going to buy the name brand. And ABBVie isn't going to lose 50% of their revenue. Could they lose 10%? Could they lose 20%? Yes, that's very possible. But plenty of people are still going to buy the name brand. Then what we want to do is look at their pipeline for the future. And we have dozens of drugs in phase 1, phase 2, phase 3. So we have things in the future to take up that area that Humira is losing. So we can feel comfortable knowing that there are more things to take the place. They have dozens of drugs. It's very likely that some of them are going to be approved and they're going to be able to recoup the losses from Humira. So with that, let's go take a peek at our income and check out the payout ratio there. So let's go down to our net income. And here is something very interesting. They were increasing a little bit up to last year, but then we had this huge drop off in 2020 where their income plummeted 42%. Now this is very strange. So let's go up into our income and see if there's anything out of place here. And we do have a couple of very interesting lines. In particular, our unusual expenses. Their unusual expenses went up to $10 billion. For anyone who doesn't know, unusual expenses are one-time things that they had to pay that were unusual or unexpected. This could be things like a factory burning down, a warehouse getting flooded and destroying stock, having to close down a plant in a country because there's a civil war going on. These are weird things that happened that they couldn't expect. It could be something due to COVID. Perhaps they had to take a loss because of that in some way. We don't know. But this is a strange anomaly, so let's keep that in mind. Now let's keep going up and look at some other things. And if we see here in our amortization, sorry for the word, of intangibles, which is essentially just depreciation of non-tangible objects. This is things like intellectual property, which for a pharmaceutical company is very important. These are things like patents. So their patents, they have lost money on over time, and they've essentially written those off. So I don't even want to count last year because of how odd it was for them. So instead, I'm going to go back to 2019 and do our payout ratio for that. So when we do that, we do have a bit of an issue. We had $8.33 billion paid in dividends over $9.86 in income. That's over 100% payout ratio. That can be very alarming. If they continue to increase their dividend and they don't have the income to support it, we can expect that free cash flow to also take a hit. So it's a bit of a red flag. You need to be careful with this. If I'm looking to invest in ABBVie, I'm looking at this year and next year to see if this number, this 4.57, shoots back up to 7, 8, 9 billion. If that happens, I can look at it comfortably and say, 2020 was just an anomaly. I don't have to worry about this. It was just a bad year. My dividend is safe. If not, if this 4.56 billion turns into only 5 billion, I might be a bit worried, but we can't really know that until this 2021 year comes to a close. So what can we take away from this? If you're looking to get into the pharmaceuticals for a dividend, you're really not going to do much better than 4.87%. Most of its competitors are going to be below that, and most of its competitors aren't going to have the 49-year increase in dividend history. But you have to keep that net income in mind. If that doesn't improve, you might not want to look at this company. But that's really up to you. These are the kind of things you have to look at when you do a deeper analysis of a dividend. Am I going to be getting that dividend in the future when I want it? I hope this helps, and thank you all for listening.